Good morning and welcome to OneAscent Investment's Q2 market update call. We've got a lot of exciting information to share and lots to cover. We are glad to have you here, and thank you for spending a few minutes of your time with us today. As we jump into our agenda, just a few kind of quick housekeeping items. Today my name is Pearson. I'm the President of Investment Solutions here at OneAscent. I'll be your host and give just a quick overview of our firm. We'll then turn it over to our manager spotlight, Liberatore of Nuveen, and excited to have him join us. And we'll conclude with an investment committee update and outlook from our Director of Portfolio Strategy, Nathan Willis. If you have questions throughout the call for any of our speakers, please submit those by email to info@oneascent.com. You can also use the chat feature within GoToMeeting if you'd like, and we'll be monitoring both of those and hope to answer your questions where appropriate. And if you're a planner and want to think out, we have these calls on the third Tuesday of every quarter at 10 a.m. Central. And so we'd love to have you join us for the last two of the year, July 19th and October 18th. You can go ahead and set those on your calendar. Well, as we get started, I want to give just a quick overview and intro to OneAscent Investments. Many of you who have been on these calls in months and years past know that OneAscent is a family of companies, that we do lots of different things here at OneAscent. But OneAscent Investments is our asset management arm, or our investment management arm, where we are fully and laser focused on developing values-aligned, kingdom-driven investment solutions for advisors and investors. And our passion is investing in businesses that bless the world. What that looks like, just a few kind of by the numbers. OneAscent Investments was founded in 2017 at the same time as OneAscent as a whole. Today we have 10 team members, seasoned professionals who average 16 years in the industry. Collectively, across 44 different strategies, we manage about $700 million of assets under advisement and primarily serve, again, financial advisors, clients, institutions, faith-based organizations, and retirement plans. That's a little bit about our firm. I want to share just quickly about our philosophy. Our investment philosophy informs everything that we do. And it's really based on three key pillars, three components. The first of which is values-based. We believe at our core that aligning your values with your investments is a wise approach to investing. There's a lot in that statement, and we'd love to unpack that perhaps on other calls that we'll be doing in the near future. Number two is long-term. We maintain a long-term focus, both in investment analysis, but also in the management of our business. And that's for our investors and for our clients' benefit. Number three is globally diversified. We believe it's wise to invest across multiple markets and asset classes to mitigate risk and to enhance the potential for long-term return. Something that undergirds all of this is another fundamental belief. And that belief is that business is a powerful engine that God has given us to impact the world. Therefore, we must invest intentionally. So I want to spend just a moment unpacking that in a little more detail with what we call our approach to values-based investing. When you think about impact, impact is just a benign term, right? So we need to start thinking in a couple dimensions. Number one is who does business impact? And we believe that business impacts people and places, every single person and every square inch, right? And the business does that in terms of people through the employees that work and serve at that business, through the customers who are one-time or repeat consumers of the goods and services that business produces, and then also the suppliers, the other businesses that business interacts with in the making of its goods and services. That business impacts those groups of people, but also places, the natural environment, the local community where that business operates, and then the society at large. And so those are the who of an impact, but we also need to think about the how. Right? Impact is benign. It can be a positive impact or a negative impact. And so we need a framework as we think about values-based investing of how to determine and ascertain what that impact looks like. And so we've created a simple sort of three-step process to do that. Number one is eliminate. This will be the negative impact. We want to eliminate those companies whose products or practices cause harm. We take those off the shelf and we will not invest in them. Number two, we evaluate. This is the traditional investment diligence and investment work that firms across the country have been doing for years. We simply evaluate companies to identify those that meet our investment objectives, right? Are they a good investment? from a financial sense. But the final step is elevate, and that's the positive impact assessment. How do we identify those companies who are truly making the world a better place through the products and services that they produce, through the ways that they interact with those people and places? So that's our approach and the framework through which we do that. One of the ways that takes shape is through our flagship strategies, which are what we call our turnkey models, where we take that lens, that framework, and put that into a risk-based, globally diversified portfolio. So that whether you're an advisor or you're a client and you have an advisor, you can identify the portfolio that fits your needs based on your risk objectives and your financial goals. And you can implement that through a risk-based, globally diversified portfolio. As we zoom in and begin to transition to our keynote speaker, I want to give a picture for our investment process and what that looks like in practice. So again, this is just a visual where we take an investable universe here at the top, and hopefully you see some familiar words. We do this for every single strategy that we manage. The first component is that values alignment, or the eliminate piece. Number two is the fundamental analysis, or that evaluate piece. That's where our financial and valuation work really goes in. Number three would be the impact assessment. And as we're doing this work, the universe of companies and investments that kind of fit all of our criteria begin to get smaller and smaller. Finally, it's time to construct the portfolio. Depending on the product or the strategy that we're managing, we seek to optimize that portfolio to achieve our desired characteristics. And in this example, that leads to, down at the bottom, the OneAscent Core Plus Bond ETF, which is our newest offering and what we're excited to introduce to you all today. We have been working on this for about 9 months, and we're excited to launch this product and this fund just a few weeks ago, right at the end of March. To do this particular fund, we've partnered with a great firm. We spent a lot of time vetting and identifying who that partner would be. We've landed on Nuveen Asset Management, where Stephen Liberatore, who will be our next speaker, is the head of ESG and impact investing for their global fixed income team. Again, our process is values-based, and we've decided to work with Nuveen and partner with Nuveen to implement that strategy into this fixed income ETF. Steve is, like I said, the head of ESG and impact investing at the global fixed income team. He and his team oversee about $17 billion in fixed income solutions. Stephen is a leader in the impact and ESG space, serves on many councils, and is a thought leader, often speaking or quoted in lots of different media outlets and publications. So Stephen, we're glad to have you with us, and I'll turn it over to you for a fixed income update and outlook.
Thank you, Cole, and thanks everyone for dialing in here, and really appreciate the opportunity to speak with you. And it's a great opportunity for us at Nuveen to work with a great firm like OneAscent and that's doing such great work across all of its platforms. So thank you again. So I'll just start with a quick overview of Nuveen. We are a global asset manager. We have roughly $1.3 trillion of assets under management, and it's pretty well broken out between fixed income, equities, real estate, real assets, private capital, and multi-asset. So we are involved in every aspect of the asset management business on a global basis and have continued to grow through the years. If we flip to the next slide here, this will give you a little bit of a breakout of our global fixed income business. What you'll see is, again, a broadly diversified platform that has over 125 professionals dedicated to these particular mandates. And they cross multi-sector as well as individual sector and very specific types of strategy mandates, such as the ones I manage, which are dedicated to ESG and impact. We are very fortunate, as a PM, we really rely upon the resources that we have to be able to evaluate transactions, issuers, and really help in the portfolio construction process. And as you can see in the table on the bottom left, we're really fortunate to have we have 68 analysts that have about 13 years of industry experience. We have 20 traders that have about 16 years of experience. And our PM team in its entirety we have 43 members there, that have a little over 20 years of experience. And Cole was very kind in his description of me and introduction. Basically, he was saying a lot of nice words to make it, cover up the fact that I'm just old. So I've been doing this since I've been about 25 years into the business, and I've been managing dedicated ESG impact strategies for about 18 of those 25 years. This next slide kind of just gives you an idea of what our overall team looks like, and hopefully, again, what it shows is the breadth and depth of our experience and expertise. And it's really critical, I think, for any sector or asset class to make sure you have that breadth and depth of experience, but especially for something like an dedicated ESG or impact strategy, having these types of resources really puts us in a really strong position to be able to evaluate transactions that maybe others can't or aren't able to because they don't have these types of resources or this level of expertise. So it's really an important function to be able to see these types of resources available to us as a team. And importantly, on my team, we continue to grow as well. And the resources from the firm are there for us to continue to do our work and be able to continue, hopefully, to provide the same level of skill that we have to date. We flip over a little bit more into my team specifically on the next slide. So this is really an example of how we conduct our portfolio management and construction process. So as the lead portfolio manager, I'm responsible for ultimately every investment decision. And then I work with the members of my team, which include my co-PM, Jessica Zarzicki, and my associate PM, Adam Garino, in the day-to-day management of the portfolios under our purview. So as Cole was nice enough to say, we manage a variety of different mandates. Currently, they are all dedicated to ESG and impact, and they aggregate up to today, thankfully, a little bit over 18 billion in total assets. And it continues to be a very rapidly growing space for us. And in fact, for our entire platform for global fixed income, our team is the fastest growing. So I think it just speaks to the opportunity set here in this space and hopefully the experience that we've been able to bring to the table and hopefully the longer run performance we've been able to generate. And on team, what we will do from the portfolio management perspective is we're going to look at where we want to be, positioned both duration wise on the yield curve, where we're seeing relative value, how we want to structure the ultimate portfolio. And so we then will work with our research analysts and our trading team to, as well as the other portfolio managers, to identify those securities that we believe fit into the profile we believe is going to help to outperform going forward based on the current economic conditions. So effectively, when we look at the sector portfolio managers, that's a key breakout. I am the sector PM for those areas where I have a background or expertise. So that would be rates and credit. So I manage our treasury and agency portfolios as well as our credit portfolios, so investment grade, high yield, and municipals. I then work with our sector portfolio managers on the structured side. So that would be CMBS, ABS, and MBS to help profile and position those portions of the portfolio to ensure that they match up with where we're seeing relative value and where we believe the market is going to be going from here. There is a lot of iterative discussion and conversation with the sector PMs. I also talk to my other lead PM colleagues that are managing different types of strategies just to get a sense of where they are seeing the market, where they're positioning, how they view, current risk profile. And we also, and that's a very iterative, real-time process that kind of just occurs continually. We also have a weekly investment committee meeting. I'm a member of our investment committee where there's a little bit more of a formal discussion around current market conditions and where positioning and profiling are currently occurring across the platform. And then importantly, at the bottom of this slide, what you'll see again is the fact that we are touching every part of the global public fixed income market as far as pulling for investments and where we're looking to make investments. So you'll see investment grade, all securitized. So again, commercial mortgage-backed securities, asset-backed securities, mortgage-backed securities, international EMD. We are a very large player in emerging markets in my strategies. And we find a lot of relative value there, but we also find a lot of very impactful issuances that we like in that particular market. We do a lot with taxable municipals as well, and in leverage finance, so high yield type securities, both bonds as well as high yield loans. Looking at the next slide, and this is really an important one for us, just to be able to express how we go about what we're doing within the portfolios we're managing. So we really approach it from two different perspectives. They are related, but they are distinct. So securities only make it into the portfolios that we're managing based on one of two criteria. They're either deemed to be an ESG leader or they are an impact investment. So let me start with ESG leadership. There's a lot of misperception in the marketplace around what ESG actually is, or what it means, or how it's utilized. And for us, the way that I think about it and the way that we utilize ESG factors is simply to identify issuers who will have, going forward, a more stable free cash flow profile. In our assessment of ESG, what we're simply looking at, and the data that we have shows that issuers that perform well on ESG criteria tend to be the best operated and managed issuers. So they take into account a wider variety of risks to their business operations or to their overall operation. And as such, because they're viewing a wider risk lens, they end up having a more stable free cash flow profile, which is important in any asset class, but especially one like fixed income, which is an asymmetric payoff. So that ability to identify and evaluate stability of free cash flow is really critical to helping outperform over time. And the way that we really do it is we are working internally to identify controversial business practices, different types of operations we don't want to be involved with. And then we're working with our separate responsible investment team internally, and then third-party data providers, MSCI, Sustainalytics, Bloomberg, Barclays, to help us create an eligible universe that would be representative of ESG leadership. And so that's a constantly moving group. What we're looking for are issuers, again, that we believe have strong ESG criteria, because we're looking for that stability of free cash flow. The easiest example I can give you, and I hope this helps, to dispel some of the misperception around ESG, we're not telling anyone not to invest in oil and gas, for example. But what we are saying is, if you do invest in oil and gas, you want to invest in those oil and gas issuers that are good stewards of the environment, because they tend to be fined less, they tend to win more business, and as a result, they have a more stable free cash flow profile in the long run. They have less maintenance costs. They have less CapEx dedicated simply to maintaining current operations, because they're not fixing problems, because they've already dealt with them up front. So again, that to me is really what we're looking for, are issuers that are thoughtful and forward-looking enough to help reduce risks to the free cash flows that they generate. So again, what we want to do is, in an environment where the market is in a risk-off position, what we tend to see is that our ESG leaders tend to help outperform, because they are less risky on a relative basis. There's a risk management component associated with ESG leadership. On the impact side, that is a different approach. What we're looking for there is security that has a direct and measurable social and or environmental outcome associated with it. So for us, impact is direct and measurable. It's tied to the concept of transparency and disclosure. We want to know how the proceeds are being used, and we want to be able to receive resulting impact metrics that tie to and speak to how those proceeds are utilized. In the bottom left corner of this slide, what you'll see are the four thematic areas that we focus on. Affordable housing, community and economic development are our two societal themes. Our two environmental themes are renewable energy and climate change, and natural resources. We flip to the next slide. You'll see a breakout of exactly what we're looking for, or the types of investments that you would expect to see in those four thematic areas. Affordable housing is fairly straightforward. Community economic development, those are opportunities to provide services or resources to underserved or disadvantaged communities. Urban revitalization, rural revitalization, providing funding for, say, broadband internet access in rural communities, or providing financial literacy opportunities to individuals in underserved areas. Renewable energy and climate change, exactly what it sounds like. We're looking to invest in renewable energy opportunities. Solar, wind, geothermal, hydro, assuming that it is run of the river and there's no damming that's been involved. Energy efficiency projects that conserve energy or conserve resources. And then natural resources, these are types of things where you want to opportunity to find conservation of land, conservation of water resources, remediation of polluted or contaminated sites. Clean water has become another large opportunity set for us. And then most recently, and one of the more interesting deals that we've done, is we were the lead investor in the World Bank's Rhino Conservation Bond, where the proceeds were being utilized to help fund growth programs for the black rhino population in South Africa, which has not only environmental benefits as an apex creature in those ecosystems, but also has societal and community development opportunities because of associated ecotourism and other businesses that are related to local communities interacting with and having jobs provided by these natural preserves and these natural areas of South Africa, including additional conservation of land. At the bottom, you'll see how each of these 4 thematic areas align with the UN Sustainable Development Goals. They are very much in alignment, as you can see from here. We do this because an increasing number of investors are starting to utilize the SDGs as a lens to evaluate impact. So it's important for us to be able to show the alignment that we have, with the SDGs. It also gives me a chance to talk about how I'm going to say a lot during this presentation about how we're a leader and we're thoughtful and forward-looking. But we also constantly are looking for third parties to validate that. So in our ESG leadership approach, we have been evaluated by the UN Principles for Responsible Investing as having a straight A with a couple of A pluses thrown in as our report card. And on the impact side, we are in alignment and have been verified by a third party called Blue Mark as being in alignment with the operating principles for impact management, which is a very rigorous process put in place by the IFC to evaluate how you go about managing impact and evaluating impact within a portfolio. So we're very happy to be able to talk about third parties validating what we do, because we want to make sure that we continually remain at the forefront of this particular industry and making sure that we are constantly looking forward and seeing how we can continue to evolve and improve our process. On the next slide, this is a really important one from an impact perspective. We are one of the largest, if not the largest, public fixed income impact investor. And because of that, we have thankfully been able to, I think, earn a hard-won reputation as being thoughtful, willing to look at new, unique, different types of structures, which we're able to, again, as I mentioned, because of the resource base that we have and the expertise and experience that we have on team. And so what you'll see on this list is the fact that we have primarily been the lead investor in every inaugural type of transaction in the marketplace. And that goes all the way back to the first index eligible green bond, the first solar loan and lease, the first labeled CMBS transaction, the first forest bond, the first blue bond, and as I mentioned now, the first rhino conservation bond or a wildlife conservation bond. So I think what this really does is it puts us in a position to be a very strong advocate for our investors, because we are engaging with issuers in the early parts of transactions. We're able to help structure and provide insights and ability for us to identify where we would participate and what we would want to see. So it allows for us to really be a strong advocate for our investors, to ensure that the deals that we participate in really reflect the transparency and disclosure that we believe are critical in this particular market. You'll see in the middle of the slide that in 2020, myself and my team had 84 different engagements. Those will vary from individual security structuring discussions to more group types of discussions or industry types of discussions or general ESG discussions. But in 2021, we had 164 as a team, and they included lots of different types of opportunities where we were able to discuss our approach and what we would want to see in a transaction, but also hopefully convey in a broader sense the approach that we're trying to take. And to me, I was, the most encouraging, exciting conversation I had last year was that I was asked to speak with the oil and gas industry CFO roundtable. And that allowed me the opportunity to really speak to them and talk to them about what we're looking for in an issuer. And it allowed them, I think, to ask a lot of questions and be able to discuss kind of their approach to the environment and what they're trying to do differently and how they're trying to transition and become more environmentally friendly, within their industry. And I think those types of discussions are really important, and they're really critical for how the market has evolved. When I first started managing these types of portfolios, we had just come out of the concept of using ESG as a purely exclusionary screen. You were good or you were bad, and that was it. And so we didn't have that engagement opportunity with a lot of issuers and in certain sectors simply because they knew that no matter what we talked about or what they tried to do, I could never invest in their particular industry. That is all stick and no carrot. So this approach of best of industry class, which is what we're doing now, identifying ESG leadership, allows us to have much more engagement with issuers so that we can continually try to improve the overall ESG quality of the issuers that we're looking at, again, because we believe that and have seen that the improvement in ESG quality translates, generally speaking, to an improvement in stability of free cash flow, which again is critical to repayment in fixed income. And the next slide, you will see, just the various groups that we are involved in, and just a couple of highlights, again, just to show how we are advocating for our investors and our clients. I was on the initial executive committee of the Green Bond Principles, so I did help to write them. I've also served on the advisory council. I've also worked on 2 different UN investment advisory groups, one for climate resilient infrastructure investing and another for blue economy investment. I'm also on the steering committee. I'm a founding member of the steering committee of the Orange Bond Initiative, which is an attempt similar to what we've seen with green bonds to identify opportunities and provide a framework and an ecosystem to direct capital to gender lens investing opportunities. I also serve on S&P's ESG Leadership Council, Fannie Mae's Green Housing Rental Task Force, and Sustainalytics Sustainable Bond Input Group. And I say all of this because it's important for us to continue to advocate for our process and our approach, because we're really advocating for our investors. But what it also, I think, shows is how rapidly the market for investments that work for us and would fit into our framework and our portfolios has how it's so greatly expanded and deepened, which as an active total return manager, that's what we want to see, because that just provides us additional opportunities to find investments that we know fit from a total return perspective, but also from the perspective of fitting our ESG leadership or direct and measurable concepts. The last slide I'll want to talk to a little, or second to last slide, the next one here. This is something that we produce for all of our portfolios that I manage. This is a short form impact report that we produce annually that shows the 4 thematic areas that I mentioned, the dollar amounts that have been invested in those 4 thematic areas, the types of impact metrics that you would expect to see. These are not all of the impacts that have been achieved by the investments, but these are the main ones in these 4 thematic areas. You'll see the raw metric of an impact, but for me, the most important column is really the one on the end, the equivalencies column. When I look and see, okay, we invested in projects that generated 455.7 million megawatt hours annualized of renewable energy. Is that a lot? Is that a little? I don't really know. But when I look at the equivalency and see that's just under 38 million homes energy use for 1 year, it gives me a sense of it as an investor of the magnitude impact that we have had within this particular portfolio and how we have been able to, very importantly, direct our investors' capital to causes and concerns that are of importance to them. And that is really critical. This, to me, besides right after our performance metrics, this slide right here is the most important data set that we produce, because we want our investors to know that first and foremost, we're going to hopefully generate good long run excess return for them, but also that we're going to do it in a way that directly aligns their values with their investment. And this is the output that they can see from how their capital is being deployed, which we think is really a critical feature to be able to show to our investors. We also just recently put out our first long form impact report that takes into account, it delves more deeply into case studies, what our approach is, has some commentaries in there, and really happy to say that report actually just won the impact report of the year for an asset manager from Environmental Finance, which is a very important publication covering environmental issues and environmental investing. So really happy to be able to say we did that. And then lastly, what you'll see on the last slide is simply an overview of the portfolio, how we're managing it, the guidelines that we have in place, and that we are running this as a Core Plus. The OneAscent Core Plus Bond ETF is very much in alignment with the portfolios that we currently manage. And this one actually provides us an opportunity to take a little bit more idiosyncratic risk and be a little bit more overweighted to some of the more esoteric impact investments that we're making, and some of the more interesting impact investments that we're making. But we want to make sure that we're doing that within the proper risk guidelines and constraints for an investor to experience ultimately a true Core Plus mandate result, but also one that has a higher ESG quality overall relative to the benchmark and relative to the peer group, but then also has that direct and measurable impact that we know investors are really looking for. So again, thank you all very much for this opportunity. It's been a pleasure, and I'm more than happy to answer any questions anybody may have.
Thank you, Stephen. Just to reiterate again for our listeners, when we set out on this journey about 9 months ago to try to find the right partner for this offering, it was clear that Stephen and the team at Nuveen checked all the boxes. They had the team in place, the experience, and more importantly than that, the commitment to what we were trying to do as values-based investors, helping clients align their values with their investments. I think it's clear that there are some firms who just talk about it and say that they do it, but Stephen and his team, it's a passion and it's sincere, and so we're really excited to partner with you guys on this new offering. We maybe have time for one or two questions before we move to our final speaker. So Stephen, the first question that came in, and again, if you have questions, submit those to info@oneascent.com. But the first question, Stephen, what we do in most of our portfolios is asset allocation. We combine stocks and bonds, right? And typically the bonds are meant to serve as a good diversifier. So the question is, how should clients think about the bond market after such a difficult quarter? What advice would you give to clients who are thinking about selling out of bonds because they haven't, quote unquote, done their job?
Right. Yeah, this has been a very, obviously a very trying and challenging year to start for sure, especially on the fixed income side, where this has been the second worst start, going back to the Depression from a quarterly basis. I think that the real importance here is that it continues to show the need for diversification within a portfolio, and that fixed income provides a little bit more of that ballast, even though maybe we haven't seen that so far this year. But also that the longer run need for fixed income continues to increase, which obviously therefore generates an underlying demand for it and support for it. And I think that what we are really experiencing right now is more the effect of really looking at, for the first time in almost most people's experience in the market, looking at a sustained higher interest rate environment going forward. Most people that have been in this industry and operating have really only experienced declining interest rates for the most part over time, and certainly systemically declining interest rates. So I think that we are in a situation that's a little bit unique. I do believe that we probably are at peak inflation. Obviously, inflation is the creation of a imbalance between supply and demand. And we're starting to see improvements on both sides. And I think that starting with next month's data, things are going to start seeming a little bit better. I don't believe we would be here in a year talking about having 7-handle inflation rates, especially considering the Fed and their ability, historically well-earned ability to reduce inflationary pressures. Now, the key for them will be, of course, can they do it without tipping the economy over into recession? And obviously, the yield curve right now is telling you that that's unlikely with an inversion currently in place in various parts. But I do think that where we are today is not where we're obviously going to be ending up, and that you will start seeing the performance of fixed income definitely starting to do its job a little bit better as we get inflation a little bit more under control and this inflation data starts to improve, which I think again is going to start on a headline basis starting with April's data, but we do see some improvement in some of the underlying data currently.
Thank you for that response, Stephen. You actually answered a few of the other questions that had come in regarding the Fed and inflation and other topics just for that one response. In the interest of time, we may move on to our next speaker, but Stephen, before we do, I want to thank you again for your partnership and for your time with us this morning. We appreciate you very much.
Thank you so much. Really appreciate it. Have a good day.
Thanks, Stephen. Well, as we continue in our call with our final segment, I'm excited to introduce Nathan Willis, our Director of Portfolio Strategy here at OneAscent Investments, to give us an update from our investment committee and outlook for the balance of the quarter. Nathan?
Thanks, Cole, and good morning, everybody. It's a pleasure to be here talking with you. What we're going to do today is talk about what happened in the quarter, but first I want to frame it by talking a little bit about our portfolio process, and we call this slide Navigating the Ups and Downs in the Market. So the first piece of your portfolio is strategic. It doesn't really change very much, and it's risk-based. It kind of sets the amount of stocks and bonds you have in the portfolio. And then we add to that, around the outside, what we call the navigation, which is our tactical work we do, and we update this every month with an objective assessment of the health of the global markets. And I think that the navigator or the navigation wording is apt right now, because in the first quarter it kind of feels like we're in a small sailboat getting battered around by the waves, and it doesn't feel great. But we make slight tactical moves that help keep us going in the right direction. So we're going to talk more about that towards the end, but I wanted to kind of lead in with the framework of how this works, and that also helps us remember how the work that Stephen and his team at Nuveen is doing fits into our portfolios. So what are we going to talk about? First of all, we're going to talk about what happened in the markets in the first quarter, because a lot happened. Not much of it was good. Second, we're going to talk about what caused the market movements. Then we're going to have a little history lesson to look at a couple of periods, two historical periods that bear some resemblance to what's going on in the market today. And then we're going to talk about how this is affecting my portfolio, which I know is very important to everybody. So first, I'm going to put on a slide here, and it's got a lot of information on it. But this is from Morningstar, and it shows market performance for the first quarter of a bunch of different sectors. And there's a lot of red on here, very little green. And the reason for that is that increased inflation expectations paired with expensive valuations led to this downdraft, right? We've been talking about valuations being expensive for a couple of years. But what I want to do is point you to a couple of particular things on this slide. First of all, the only way you made money, really, was in energy. And that was because of the oil shock because of the Ukraine war. So energy, primarily driven by fossil fuel companies, was up 40% or so. Utilities also made some money, but those were the only sectors that actually made money during the first quarter. Energy is a big component of the value index, much more than the growth index. And so you saw that value actually made money this year so far, whereas growth is down 12%, right? And it's actually kind of striking when you look at the other pieces of this section of the chart. The U.S. market was down 5% or more. Developed markets without the U.S. was down about 5%, and emerging markets was down 6%. You might want to say, well, I mean, that portfolio should be down 5 or 6%. But unless you owned these companies that are cheap, you didn't benefit. And we aren't going to own something just because it's cheap. A lot of times, what's cheap is cheap for a reason. And so our portfolios, I'll tell you, we're a little bit less exposed to that. And so our equity performance was a little worse. We were down closer to 10% in most of our equity portfolios. And the reason for that is we tend to have less exposure to energy and more exposure to transformational areas that are represented by this section in the bottom right. So we have more communication services, cyclical, and technology exposure. And that has hurt our portfolios during the first quarter. But we'll talk about the fact that that has helped our portfolios for years, and we expect it to continue to. The one last thing I'll point out, Stephen already talked about the fact that fixed income lost a lot of money, and it was the second worst start to the year since the Depression. But one thing I really want to kind of focus on in here is the fact that treasuries lost 10%. 10-year and longer treasuries, those are supposed to be the safe ones, right? Well, they lost money, and that's really because of inflation expectations. Why didn't the market work, quote unquote, the way we want it to? As I said, there are two things, inflation and valuations, right? So let's dig into both of them. But before we do that, I'm going to talk about my son. On his 3rd birthday, he decided that he ought to have 3 pieces of cake. I'm not sure why my wife and I let him do that, but at about 2 o'clock in the morning, we realized that was a bad move because he threw up. And so when we were up there changing his sheets and changing his pajamas, he was sitting on my lap and he said, "Daddy, I think I shouldn't have eaten 3 pieces of cake." And I said, "I think you're right." Well, cake at your birthday is a little bit like inflation. A little bit's really good, but 3 pieces of it makes you throw up. And that's kind of what happened in the first quarter. The markets kind of threw up because too much inflation was happening. But let's think about that. Stephen talked about the fact that we think expectations are going to come down. We think inflation is going to come down. This chart that we're looking at illustrates the same kind of thought, but from a survey of consumers. This is a chart produced by the New York Fed, and they survey consumers about their expectations for inflation. And the blue line says they expect inflation to be 6, maybe even 7% a year from now or over the next year. But if you look at the red line, that is their expectation for 3 years from now. And you can see that's already come back down. It's below 4. It's around 3.5% or so. A little bit higher than the Fed's goal of 2%, but still moderate in the long term. So we don't think inflation is going to be continuing, and it's going to be a huge problem. The second thing that we are worried about, or that hurt stocks in the first quarter, are valuations. So high valuations have left stocks vulnerable. Continuing my son's analogy, he's not that old yet, but high valuations kind of make me think about a junior high kid, right? He's driven by emotion a lot and makes irrational moves. And that's what happens when stocks are priced expensively. They tend to react more to emotion. So this slide here shows us the price to earnings ratio, so in a sense, the valuation of the stock market. And it goes all the way back to before the tech bubble, and I think that's important. The red line here is U.S. large cap stocks represented by the S&P 500. And you can see it was incredibly expensive leading into the tech bubble. The blue and the green lines are small and mid cap stocks. And you can see back in the tech bubble, they were not very expensive at all. And they actually did pretty well right until the end of that recession. A similar dynamic, but not as overstated, is occurring in the market now. We've been talking for a couple of years that U.S. large cap stocks are pretty expensive, and they've been more expensive than they've been since the tech bubble burst, right? However, for the last couple of years, small and mid-cap stocks have been less expensive. And you can see over the course of 2021, even before the market started to tank in 2022, both large cap and the combination of small and mid-cap stocks have gotten cheaper. That's because earnings have done really, really well. Well, and you can see they've gotten more cheap now. Large cap stocks are still expensive, though. We're not going to say they're not. You can see even today, they're higher than their 20-year average, except for during the tech bubble. But small and mid-cap stocks appear pretty attractive. If you look at where the blue and green lines are, they're pretty close to the low over the last 20 years. So we feel pretty good about the fact that being diversified outside of only large cap stocks is pretty effective. So the two things that hurt the stock market in the first quarter were inflation and valuations. But I want to touch base on one of the things that the market's very worried about and why inflation and high valuations really hurt. And that's what the Fed is going to do. We talked about that with Stephen. And is the Fed going to kick us into recession? This chart makes you think they might. And so this is a historical chart going back to the 50s of the Fed funds rate. So the blue line going up means the Fed is increasing rates. And the gray shadow lines are recessions. And it kind of feels like there's a pretty good pattern here where the Fed increases rates and they do it too much. It's acknowledged that it's hard to run an economy, but they raise rates too much and then eventually that kicks us into a recession. So that's what the market is worried about right now. So let's take these three things and put them all together, okay? So we talked about inflation, we've talked about stocks, and we've talked about the Fed increasing rates, okay? So what I want to do is show a chart here that appears a little bit different. This might not be a chart you're used to looking at, but it's called a drawdown chart. So what we do is you can see there's a zero and the line never goes above zero. So we actually don't care in this chart when stocks are going up. All we care is when they get to a peak, they start coming down. How far down do they go? And then how long does it take to get back to that peak? That's what we care about on this chart. And it's pretty instructive. What I've shown here is U.S. large cap value stocks in blue and U.S. large cap growth stocks in red. And I think it's very telling. And I want to share a couple of historical parallels here that I think give us some sense of where we might go. So first of all, let's look at where we are today. In the current market, growth was down 12% for the first quarter, and value actually made money, right? So it lost money, made it all back, and then went above zero, which we don't really focus on in this line. But there are two historical parallels, and I want to look at them. The first one is about valuations, and that's obviously the tech bubble. So back in the tech bubble, we had extreme valuations. It was all focused in the large cap growth names, and you see large cap growth stocks, that red line, lost 54% from the top in 2000. Value stocks, large cap value stocks, and small and mid did even better, but large cap value stocks were down about 2/3 of that amount in the mid to high 30s. What's the next historical parallel? The next historical parallel deals with inflation, because we haven't really had inflation since the 70s, and that relates to the oil embargo that was at least part of that. So let's go back to a high inflation period of the 70s. And you can see when the Fed started raising rates there, growth actually was down 54% as well. That's not a typo. They both rounded to 54. One was 53.8, one was 53.6. So it's kind of amusing that they were down the same. But what I wanted to do was point this out, and I wanted to say, are we set up for a market like that today? And we think the answer is no, right? In the absence of high market valuations of the tech bubble, we don't think they're nearly as high. We've shown that. Or the high inflation of the 1970s oil shock period, which we don't think inflation is going to be that high. We think it, our business partners think it, and the New York Fed shows us that consumers think it. Inflation won't be that high. So outside of those two circumstances, we actually don't think we're going to see significant further downside. If you look at this chart of where growth stocks are today, they're not about 12%. You might remember from information that we've shared with you on a regular basis, the average drawdown on the market is about 14% a year. So really, we've just had an average drawdown. So this really isn't something that is triggering our worry that it's going to get a lot worse. What I want to do now is share a couple of facts about those two periods and hope that we can kind of illustrate it a little bit further. So first of all, let's look at the 73, 74 oil shock. What I'm going to focus on here is returns in the stock market. So in that middle group there of information, we look at the market leaders, and I just pulled the top 5 out. So IBM, Eastman Kodak, Sears, GE, and Xerox. And those companies, their average PE was 36. If you remember back, that was the time of the Nifty 50, where there was these 50 stocks, and they were considered by everybody who invested to be, quote, one decision stocks, where you just bought them and you never had to look back. The PE of those Nifty 50 were 42 times. A little bit higher, actually, than the current leaders of the market. Apple, Amazon, Microsoft, Alphabet, and Meta are at a 33 times PE. Couple things to point out here. First of all, look at Eastman Kodak, Sears, GE, and Xerox. Much more industrial companies, much lower margins, much more capital intensive, whereas today's leaders are much more information focused and service oriented, and a higher PE is actually very justified. The second thing I want to point out is just having a high PE doesn't mean you're going to do poorly. It makes it harder to do well, but it doesn't mean you're going to lose money for sure. So I'm going to take 2 companies and illustrate that. So people have done studies that said after this crisis in 73, 74, how did these companies perform from the peak? So IBM and GE were 2. IBM actually outperformed the S&P 500 from the peak of 1973 for the next 25 years until 1997, whereas GE actually underperformed the stock market. And when you look at the whole group, there was a decent number who outperformed the S&P and a decent number who underperformed the S&P. So just having a high PE doesn't mean you're guaranteed to lose money. It makes it a little riskier, and it makes the case for what we do, which is having an outside expert managing those portfolios. It's a really important part of what we do. The second comparison is the technology bubble. I already talked about things being pretty expensive. The S&P 500 growth PE ratio was 40 times in 1999. Today, now, at the end of December, it peaked about 30, a little bit below 30. It's now about 25. So we're nowhere near as expensive. And then what I want to point out here is the market cap share and the earnings share. So the market cap share is this. Those 5 companies back in the tech bubble, Microsoft, Cisco, Intel, Oracle, and Lucent, they were the top 5 then. They were 16% of the S&P 500 market cap. But they were only 8% of the actual earnings power of the market. So they had double the share of the market than they had of the earnings. That's not the situation now. The top 5, Apple, Amazon, Microsoft, Alphabet, and Meta, are 20% rather of the S&P 500 market cap, but they're 17% of the earnings, almost the same amount of earnings power as they are market cap. So it's really not a fantastic parallel, and one that we think is actually provides a lot less to worry about. So we've talked about the fact that the market is worried about inflation, stock valuations, and the Fed. We've talked about that we don't believe the 2 historical parallels where growth stocks really got hurt are apt. But what I want to do now is talk about your portfolio. In order to do that, we're going to take a quick ride through our Navigator Outlook. It's kind of our anchor. Every quarter, every month, every week, we actually look at our Navigator. So let's talk about what the Navigator is telling us here. First of all, it won't surprise you to hear that we think stocks are expensive. They have been for a couple of years, and we've seen that. Second, let's move to the economy. We're calling the economy neutral right now because earnings are really good, even though they're coming down from last year, but there's a lot of risks. We haven't really talked about the war in Ukraine, but that's a significant risk to the economy. And the other risk to the economy is that the Fed makes what's called a policy error. In other words, they raise rates too much because they started too late. They raised rates too much, and that knocked us into a recession. So we're going to say neutral on that. The technicals, long-term, favor risk assets, so that's pretty good. And sentiment, up until last week or so, was kind of red. It was not fantastic because the University of Michigan Consumer Sentiment, which is a survey of consumers' expectations for the economy, has been incredibly negative. But at the same time, in the last couple of weeks, investor sentiment has gotten very, very, very bearish, with only, I think, 15% of respondents being bullish. In general, the fewer number of people who are bullish, the better. It means there's opportunity for stocks to go up. So overall, we kind of feel like we're pretty much neutral on the economy. So I want to get back to the original analogy I made about the navigator, where it feels like we're in a boat being knocked around by the water a little bit. One of the things I will also say is sometimes when you're sailing into the wind, you've got to kind of go off to the left or off to the right and tack back and forth. And it may always look like you're going where you want to end up. But I want to give you confidence that we are going to a place that is good, and we're going to meet goals that these portfolios are designed to meet. In order to do that, I'm going to talk a little bit about the allocations in your portfolio. Then I'm going to talk about the long-term performance. So first of all, we talk about the fact that we have 5 risk-based models, and we're going to focus on the moderate model. What we've done since this started, we've made a couple of tactical adjustments. First of all, we have shortened the duration of our fixed income portfolio, so we will be hurt less if rates do continue to go up. We've bought a little bit of inflation-protected bonds, which will help us in case inflation does continue to go up. And we've reduced risk slightly. Last quarter, we were at just ever so slightly above neutral. In a 60-40 portfolio, we were 62% stocks, and we've dropped that down to be about 58% stocks. We feel like we're relatively neutral still. We've got a little bit of dry powder. So I wanted to make sure you knew that we've made a couple of minor adjustments, but it's important that we don't make drastic adjustments. The navigator is not here to make huge adjustments. We're not market timers. We're going to stick to the plan, and we have confidence in the plan. And we have good evidence that the plan works over the long term. So we can look at any one of these performances, but I'm going to look right in the middle here at that moderate allocation. So you can see right in the center of your sheet of paper that the year-to-date performance of that allocation is down 8.7%, 3% worse than its benchmark. And the reason for that is really because our stocks had a little bit of a growthier bias and got hurt more. But it's important to remember where we're going is good and it's solid, and we have a long-term performance to prove that. We have 5-year numbers now. The firm is 5 years old. It's really exciting for us. And so our 5-year returns for that portfolio are just under 1% ahead of the moderate benchmark. Across all of the portfolios, we're essentially even to as much as 1% ahead. So we feel very good about our portfolio positioning. We want to make sure you feel confident in our process, because we do, and we're making some slight adjustments to make sure we're going in the right place. With that, I'm going to turn it back to Cole.
Thank you, Nathan. As we wrap up, I actually have one more question I want to address that I think is important and relevant for everyone on this call, especially if you've attended in quarters past. The question was, can you please discuss the difference between VBI, values-based investing, and ESG, especially as it relates to Nuveen? They shared a lot about ESG, which is something we've not discussed in the past. And so just quickly, I want to address that before we wrap up. ESG, VBI, and there's many other acronyms that are similar in letters. All that they really are frameworks, right? And a framework is just a tool for how we think about investing, how we categorize data, how we order and standardize our processes. And so ESG, you may have heard in the news, you may have seen that more prominently than values-based investing, which is the acronym and term that we use. But I want to kind of make this point clear that it is a tool, and it is very important who is wielding that tool. So as we think at OneAscent about values-based investing, for us, that comes from our faith. As a firm, that's where our name comes from. That's what we are seeking to do as a firm. And so our faith informs the values that we seek to espouse. It informs the way we look at companies. We mentioned that earlier about impact and who is impacted and how those companies are impacted. So that's an important kind of point I wanted to make. As it relates to partnering with Nuveen, it was clear that they are a large firm and they have thought deeply and longly about how to apply this. There's lots of overlap between the impact themes that Stephen mentioned in terms of affordable housing, community development, renewable energy, stewarding natural resources. Those are things that naturally align with our faith and what we're trying to accomplish as values-based investors. And so an important point to remember is that it is a OneAscent strategy. We have partnered with Nuveen as a sub-advisor. We provide our restricted list, the companies we will not invest in, to them on a monthly basis. And then we trust them to implement the process. We spend a lot of time vetting and seeking out the right partner. And we have a high degree of confidence in the Nuveen team to be able to implement value-based investing in the way that we are seeking to do it for our clients. They may call it a different name, and they've got decades and decades of experience doing that. But wanted to address that point just quickly that, again, all of these acronyms are frameworks, which means they're tools, and it's very important about how we apply those frameworks and how we use those tools. As we wrap up, we want to thank you again for your time, for spending time with us this morning. If you'd like to learn more about our solutions, you can visit our website, investment.oneascent.com. You can also email us at info@oneascent.com. We'd love to speak with you. We have lots of resources available on our website, our allocation dashboard, fact sheets, commentary, more information. A replay of this call will also be made available there. We'd love to see how we can serve and partner together with you. Again, thank you for your time. We appreciate that as always and look forward to speaking with you next quarter. Have a great rest of your day. Bye-bye.